Martin, let me first ask what you think about the price now. Is it headed higher as production cuts are held to, or is it headed lower as demand falls away like the IEA has forecast?
Yeah, good morning. Our call is that prices will ultimately need to go higher, but you're right to point out that OPEC is walking a bit of a tightrope here. The price is $70 a barrel. That is a healthy price. But it's really held there by large opposing forces. On the one hand, we have some meaningful risks to supply in a number of countries, Iran, Venezuela, potentially Libya. But then on the other hand, we also have some demand weakness coming through. In March, OECD oil demand was down 600,000 barrels a day year over year. Now the OECD is not the key driver of oil demand growth, but such a sizable decline is punchy nonetheless. If you look into the second half, what you typically see, and that underpins what is ultimately our positive call on oil as we go into the second half of the year, what you typically see is that in the second half of the year, oil demand accelerates by about 1 million barrels a day or so relative to the first half. If that happens again this year, and then Iran, Venezuela lose a couple of 100,000 barrels a day of production, you take some of the other factors into account, and OPEC is effectively signaling that they're not meaningfully going to fill this gap, then you end up with an oil market that looks quite undersupplied, particularly in the third quarter, looks very tight. We're modeling oil supply demand to be 1 million barrels a day in deficit in the second quarter. That should support further backwardation in the curve and higher flat prices.
And what explains that higher demand then as we go through the year, Martin, apart from the seasonal factors? Are you looking at fiscal stimulus as something in China and maybe in India, if Modi is successful, that drives that finds its way into stronger demand for oil?
No, the increase in demand that I just mentioned is purely the seasonal profile. You're right to point out that so far this year, demand has been a little weak. Now, usually in any given year, most of oil demand growth is typically created in the second half of the year over the summer months, which tend to see a large boost to transportation fuel demand. That should happen again this year, even from a weaker base.
What about the increase in the electric car fleet, or the increase in cars that use less gasoline per kilometers traveled? Is that a threat at all to demand, or is it just not increasing quickly enough?
It's a threat to demand, but on a time scale that goes way beyond what most people look at. If you work your way through these numbers, it would really take until the early part of the 2030s, on our numbers at least, for electric cars to displace more than 1 million barrels a day of oil demand. Frankly, on the time scale of 10 years, there are so many risks to supply and demand that are of the order of 1 million barrels a day. It doesn't really come into discussion when you look at oil prices over the next 2 to 3 years. Where it does come into discussion is in terms of investment. So if you're a typical large super major oil company, you do look 10, 20, 30 years into the future. You do think about your CapEx program. You could well have a situation where the threat of electric vehicles is already starting to constrain capital expenditure today. And that, in a sense, that longer term threat could actually perversely lead to some shorter term tightness. That's the way that it's relevant. But in terms of outright oil demand on a near term view, the numbers simply aren't meaningful enough.